All right, good evening, everyone. Thank you so much for joining tonight's speaker series all about home buying. If you have any questions throughout the session, feel free to leave them in the chat or come off mute.
All right, great.
To go.
Good evening, everyone. My name is Andrew Exta. I am a loan officer and team leader at Cross Country Mortgage. I want to take this opportunity to thank Des and the whole PCOM family for the opportunity to chat with you guys today. It's an honor and a privilege, to work with such an amazing institution and all the members of it. So again, thank you so much. Cross Country Mortgage is the #1 lender in the state of Pennsylvania and a top 3 lender in the country. So very proud to be a part of an awesome organization. I've been doing mortgages for about 20 years now, which is kind of strange to say. And my specialty is first-time home buyers. So a lot of people like yourselves that are looking to purchase your first homes. I also do move-up buyers, buyers that want to buy second homes, investment properties. But my career has primarily been focused on helping first-time home buyers purchase homes. And I've also helped many physicians, like many of you, purchase their first homes as well and help them navigate through the process. So again, thank you so much for having me. So the things that we're going to cover today, the 3 driving factors to getting pre-approved for a mortgage, the types of mortgage loans that are available, and what it's like being a buyer in today's market. Since many of you have matched recently, which congratulations to all of you. I know it's very exciting. Now is the time that you're actually going to start looking in different areas for purchasing. So we are licensed. I'm licensed personally in the state of Pennsylvania. So I deal primarily in Philadelphia and the Philadelphia counties, but I'm licensed in the entire state, as well as New Jersey, Delaware, Maryland, and Florida. So if any of you are getting matched in any of those states, we can certainly help you with the mortgage, okay? So the 3 main driving factors for getting pre-approved is, first one's credit score. So everyone here probably has an idea of where their credit score is, because many of us now have Credit Karma or some sort of app on our credit card that shows us where our scores are. Everyone typically has a decent idea of where their scores are at. They don't always know what's on the credit report, but they have an idea of what the scores are. The second element is called debt to income ratio, which I'll explain what that is. And then the third element is available funds for closing. So how much money do you have saved for down payment and closing costs? And that there are other factors with that as well that I'll go over. So let me give you a quick little excerpt on credit scores and how credit actually operates. We do a free credit consultation. When you do a consultation with us, we do a soft credit check. So there's absolutely no adverse effect to your credit score whatsoever. And it allows us to do a full review of everything that you have going on with your credit score and all of your income and your assets, okay? The credit scores are made up 10% of new credit. So if you've established a new credit card over the last 6 months, 10% is how quickly or how long you've had established credit. 10% are types of credit. So types of credit are revolving debt, which are credit cards, installment loans, which are car loans and student loans. And there's mortgage loans, which are residential mortgage loans that are on your credit report, okay? The length established is 35%. So someone that's had credit established for, let's say, 20 years is going to have a higher credit score than a 19 or 20-year-old that's only had credit established for 1 or 2 years. And then 30% of your credit score is determined by your payment history. So someone that's never been late on a credit card or any type of thing that they have on their credit report is going to have a higher credit score than someone that's been late or has any kind of collection account. Debt utilization means the amount of credit that's available to you versus how much you've utilized. So for instance, let's say you have $10,000 in available credit with, let's say, 4 different credit cards. The person that has utilized 9,000 of that 10,000 is going to have a lower credit score than the person that's utilized 3,000 of that 10,000. You typically want to keep your credit card balances to 30% of the available credit, okay? Closing, there are a lot of myths out there with credit scores and credit. Do not close good positive accounts, okay? So if you've had an account with a department store or a gas card that's, let's say, 5-10 years old and you don't really use it, my recommendation is to use it once every 6 months, even if it's not your main credit card, and then pay it off that same month so it continues to report positively on your credit score, on your credit report, okay? There are two major types of loans, conventional loans and FHA loans. Conventional loans typically require a 660 credit score, and FHA, which is a government-backed insured loan, typically requires about a 620. Those are the approximate numbers. There are a few other type of loans that we'll go over, but those are the two main ones that most available in this country. So debt to income ratio. This is typically the thing that confuses most people because there is a little bit of nuance with it, okay? But I wanted to give you a real life example of what this looks like. So let's say someone makes $100,000 on an annual salary, okay? That's $8,333 per month. Let's say you have a car payment of 300, student loan payments of 200, which might be a little bit more for some of you on this call. But again, for this example, we'll just say 200 in student loan debts and $100 in credit card payments, okay? So your total monthly liabilities on your credit report are about $600 a month, okay? If we take 45% of your $8,333 of monthly income and we multiply times 45%, that's $3,750 a month. 45% is typically the maximum debt ratio that most banks and lenders allow. Okay. So the way we determine your maximum mortgage payment allowed is we take that 3,750, we subtract the amount of monthly liabilities that you have on your credit report, and the remaining number is the housing payment that you could be approved for. Okay. So in this example, we subtract 600 from 3,750, and that means you can have a mortgage payment of up to $3,150 a month that you can get approved for, assuming great credit and that you have enough money for closing. So a lot of people are confused. Okay, what actually goes into debt to income ratio? Okay, they are only things that report on your credit report. So that's credit cards, car loans, student loans, mortgages. That's it. So anything that does not show on your credit report is not included in your debt to income ratio. So things like your water bill, your electric, your gas, those are not included. Your cell phone bill, your auto insurance, your memberships, Netflix, the gym, anything that you belong to that doesn't show on your credit report is not factored into your debt ratio. Okay. But it is very important to factor all those in when you're doing your budgeting with regards to purchasing a home. You obviously want to make sure that you're aware of all of what your monthly bills are with the things that are on your credit report and all the things that are not on your credit report. Because even though they're not factored into the debt ratio, at the end of the day, those are bills that you have to pay and you want to account for those bills. Okay. So funds needed for closing, okay? There are two major elements that go into purchasing a home, just like purchasing a car. There's the down payment, so that's the money that you're putting towards the purchasing of the asset. And then there's the closing costs, which are the transactional fees that come with making the purchase. So, most of you have purchased a car loan before, so typically you'll put anywhere from 1,000 to a certain percentage as a down payment. And then there's the stocking fee and the other fees that go along with purchasing a car. Those are the closing costs. So it's the same type of thing with a home. Okay. So with mortgages, you can put a minimum of 3% down. Some of the doctor loans will do a 0% down. So, and I know that's relevant to this crowd, but the majority of the loans that are done that are non-physician loans, 3% down is the minimum conventional, and 3.5% down is the minimum for the government insured FHA loan. Okay. Most people don't know that closing costs can come from a variety of different areas. Okay. You can use your checking and savings or your brokerage accounts. So any investment accounts that you have and your liquid accounts, like your checking and savings, you can use those. You can get a gift from a family member. So if mom or dad or grandparents, aunt or uncle want to give you a gift towards purchasing a house, you can absolutely do that as well. And then retirement funds. That's not really going to be relevant to this crowd, but if let's say you've been working and you have a retirement account that has some money in it, typically you can access 50% of the funds that are in that retirement account to utilize for a new home purchase. Okay, so just something to keep in mind. And then the closing costs, there are a lot of things that go into that. I'm not going to account for that on this call, on this Zoom call. But typically, if you want to have an idea of what they are, it's usually between 4 and 5% of the sales price of the house. So if a house, let's say, is 300,000, you can assume closing costs are going to be anywhere between 12,000 and 15,000 for that home purchase in Philadelphia, in Pennsylvania as well. So the basic loan types, like I said, are conventional and FHA. So conventional is the most common type of mortgage that we do in this country. Typically, you have to have a higher credit score, like I went over earlier. Minimum score is usually about a 660, but ideally, the higher credit score you have, the better it's going to work out for you. Your debt to income ratio has to be about 45% or less. Again, it's not an exact number, but that's a good approximation of where we want you to be. The minimum down payment, like I said, is 3%. And then with regards to closing costs, depending on the kind of market that we're in, meaning if it's a seller's market, if it's a buyer's market, right now the market is very hot. So it's more of a seller's market. But in a market where it's more of a buyer's market, you can ask for what's called a seller's assist, which is when the seller will give you a portion of the sales price to cover some of your closing costs. So that means, let's say you're purchasing a $300,000 house and you get a 3% seller's assist. That's $9,000 that contributes to your closing costs. The maximum loan size for a conventional loan is $766,500. So basically, you could purchase almost an $800,000 house with only putting 3% down. And for those of you that are going to be physicians, you literally can put down 0% for some of you, and you can get a house with zero money as a down payment. So pretty cool. FHA is a government insured loan. Typically, it allows up to a much higher debt to income ratio. You only need 3.5% down, and lower credit scores are allowed. So let's say you've had some boo-boos in the past and your credit score isn't as high as you want it to be, or your funds are a little bit more limited, then FHA could be a great option for you. FHA allows for a 6% seller's assist. So basically the seller can cover all the closing costs if that gets incorporated with the offer that you make. For this type of loan, the maximum loan size is $498,257. So basically you could purchase a home for about $515,000, $520,000 with only 3.5% down. The two other major types of loans are VA loans. So those are for the members of our military or their deceased family member of someone that was in the military. This is a zero down loan. So again, just like the physician loan, you can put down no money. You just cover the closing costs. The maximum loan size is same as conforming, so $766,500. And VA is very flexible with credit score and debt to income ratio. It really is a case by case basis with them. And then USDA is when you're looking to purchase in a rural area. So that's 50 miles outside of a major metropolitan area. Every county has different income limits, but it's also a 0% down loan. And debt ratio is very, very strict with these loans because it is a government-backed loan based on the county of which you're buying in a rural area. So I wanted to give you an example of a conventional loan with 3% down. So let's say we have a sales price of $600,000 with property taxes of $3,000 a year. This is not uncommon in Philadelphia. This is actually pretty common with these taxes and this sales price. The homeowner's insurance, let's call it $400 a year. So that's about $117 a month. If you're putting down less than 20%, I'm sure the majority of you have heard of PMI, which is private mortgage insurance. So if you put down less than 20%, there is an element of that. If you have higher credit scores, then the PMI is always going to be a lot less. If your credit score is a little bit lower, PMI is going to be a little higher because risk level goes up a bit. Typically, in this example, if we have a rate of 6.75% on a normal 30-year fixed rate loan, you have a loan size of about $582. Assuming a credit score of about 720, you're looking at a total monthly payment of about $4,300 a month. So that includes everything. That includes your loan payment, your homeowner's insurance, your property taxes, and your PMI. So that's your all-in payment right there in this example. And the total funds that you would need for this purchase would be about $37,500. Okay, this is a very generic example. Obviously, every house is going to be different, but I wanted to give some context as to what this looks like based on this kind of sales price and these taxes. FHA, let's use an example of $400,000. Again, taxes of $3,000 a year. Homeowners insurance a little bit less on this example because the purchase price is much less. We'll use a rate of 6.5%. If you have a 660 credit score, basically you're looking at an estimated monthly payment of about $3,000 a month and total funds to close of about $21,500. So again, a little bit of a lesser sales price. So obviously the payment and the closing costs are going to be, the funds to close are going to be a little bit less, but this gives you a good idea of what something like this would look like. So if you're looking to buy in like the Point Breeze area or some different parts of Philadelphia, you're going to be anywhere between that like 350 to 450 range. So this kind of gives you a good idea of what this might look like for you. So let's recap. You want to have a great when you're looking to purchase a home, you want to have a good idea of where your credit score is, if there are any negative things that are on your credit report, and you want to have a good budget. You want to have a good idea of what exactly that you're going to be paying on a monthly basis, and you absolutely want to factor in what those student loan payments are going to look like. Because obviously, many of you are going to be in income-based repayment programs, based on your income, and it changes year to year. So you want to make sure that you're budgeting for that along with everything else when you're looking to purchase a home, which is something that we do when we do our consultation with you. You want to make sure you have a great idea of what all those debts are and what they can be and what you're comfortable with. So obviously, if you're going to be buying with another partner or another person who's going to be purchasing the home with you, then obviously your budget might be a little bit higher, but you want to make sure that you're in a comfortable spot. And then you also want to make sure where the funds for closing are going to come from. Okay, so okay, I have this amount saved. Let me speak to my parents to see if there's any opportunity for a gift or if there's any other way that I can get funds from a retirement account from a previous job, or am I expecting a bonus from a job that I currently have? All those things have to factor in for funds to close. So right now, 2024 obviously just started. So I wanted to give you guys an idea of where things are at. Right now, interest rates are in the high sixes. Okay. We're expecting that by the end of the year or by quarter 2 of next year, they're probably going to go down to the mid to high fives. At least we're hoping. We've had higher interest rates for the last year and a half or so. We've had some reprieve, but over in the last 2 to 3 months, because inflation reports have not been as strong, they haven't gone down as much as we would have liked it to, and unemployment numbers are still pretty low. The Fed has not lowered the interest rates quite yet, but as of today, they actually announced that they're going to lower the Fed funds rate by about 3 times, hopefully before the end of the year. So we're hoping that rates will start to come down. The 10-year Treasury is usually the barometer and the thing that we compare most to when it comes to 30-year bonds. So if by chance you're looking at Yahoo Finance or whatever you're looking at, if the 10-year Treasury goes down, that's a great thing for you. So that means interest rates are going down. The biggest issue that we've had in our market is that we don't have a lot of homes for people to buy. In Philadelphia, we actually have some decent inventory, but in the suburbs of Philadelphia, there are very few homes for people to buy. So what does that do? When you have more demand and less supply, that raises the prices of the homes. So over the last 2 years, we've seen prices go up at a pretty high pace, and we don't anticipate that's going to stop anytime soon because we have a lot of demand and very little supply. So we're hoping that when interest rates come down, that will create a little bit more inventory because it'll make sellers want to sell and create more houses for people that want to buy. So one of the biggest questions I get asked by a lot of clients right now is, Andrew, I want to wait till rates go down. Okay, well, I want to give you an example of what it looks like between buying something now and how much money you're actually going to lose by waiting. All right. So this gives you an example of purchasing a $500,000 house in Philadelphia in the area of Northern Liberties. Okay. So if you're purchasing a home for 500,000 today at a rate of 6.5%, then you can see what the payment and everything looks like. It's on the screen, so I'm not going to go over it with you. But then you can see by what the appreciation by waiting 6 months, 1 year, 2 years, and 3 years. Look at this. So this shows you what the cost of waiting is. So if you want to wait 6 months to buy that same house, it's going to cost you an additional 20,000. And in reality, it's going to cost you even more because in Philadelphia right now, we're seeing anywhere from a 3 to a 5% appreciation over the last 12 months. So that same house is going to sell for a heck of a lot more if you wait 6 months or a year than what you can purchase it at right now. So if you look all the way to the right, where if you wait 3 years to purchase a home, you're losing $72,000 between the amortization, meaning the loan size, the loan amount that you're going to pay down, and the loss of appreciation of that same property that you could have bought 3 years earlier for that much cheaper. So I give people this idea, this example, and I can do this in any area. We have technology that will show you exactly what this looks like for almost any neighborhood in the country. So if you're looking to purchase in, in the suburbs of Philadelphia or in another state, we can do this for you very easily. But this kind of gives you some context. Okay, why should I wait or should I buy now? So the answer is you buy now because we can refinance later. But the same house that you can buy now is not going to be the same price in a year from now that it is today. So what differentiates us from a lot of like the big banks out there? So if you went to any of the major banks like a Wells Fargo, a PNC, a Bank of America, they are stringent with their programs and what they allow. We have and offer a variety of programs for pretty much any type of buyer. So we can go as low as credit for a credit score of about 500. Again, this is not the industry standard, but we do have the availability to be able to do certain programs. We can do programs that allow for higher debt ratios. So right now, let's say your student loan payments are a little bit higher. We have a little bit more flexibility than major banks would because we don't have thresholds like they do. We have more flexibility with the programs that we can offer. We can do investment properties with only 20% down without even showing income. I'm not going to go through that type of loan, but just to give you an idea, without even showing income, we can get you financing for a property with only 20% down. Many of you might get jobs where you're 1099. So that means that you're a subcontractor. Some of you might be working for multiple offices. I've had clients that have worked for one office 2 days a week. They work for another office the other three, or they mix it up, and some of them are paid on a 1099. We have 1099 loans that you can utilize to actually have more income, qualifying income for you than if you were a W-2 employee. We also have bank statement loans. We have new construction loans if you're looking to purchase a new construction property. And again, we have physician loans as well, but there's going to be another speaker, I believe, next week that's going to discuss that in more detail. But we do have physician loans that are zero down that allow for you to purchase a home that could be up to, million, 1.5 million with 0% down. So it's pretty cool. Another cool thing that we have is that we offer a lot of down payment assistance programs, more than most lenders in the country. So in Philadelphia and the surrounding counties of all PA, but we listed here the ones directly surrounding Philadelphia, this program allows us to give you 5% of the purchase price to cover closing costs. So basically, as long as you meet this criteria, so in Philadelphia, as long as you're purchasing a home of less than 659,000 and your monthly and your total household income for a 1 to 2 person household is less than 137,200, you can basically purchase a home for 3% down because all of your closing costs are going to be covered. And the cool thing is, if you actually get a seller's assist, I've had buyers purchase a home recently with only $1,500 out of pocket utilizing this program. So very, very cool. And I can go into more detail with it when we do our own personal consultations, but I like giving that example. Another cool program that we have is called Borrow Smart Access. Essentially, if you make less than 91,000, we could give you $4,000 to help you cover closing costs. If you make more than 160, then we can give you 3,000. It really depends if you fall within the current MSA, which is the Philadelphia area. So if any of you are buying in the Philadelphia region, you will qualify for this program. It does require a phone call with a one-on-one counseling session. Community Promise is a proprietary down payment assistance program that only Cross Country offers. It is based on where you currently live, not where you're buying, but where you currently live. So some of you might live in what's called a low or moderate census tract in the Philadelphia area, and it doesn't matter if you're renting, living rent-free, none of that matters. If you're living in one of these designated areas and it shows on your credit report, we can give you $6,500 free money, no liens on your property to help you cover some of these closing costs. So you do have to be a first-time home buyer. Even if you get your first contract and you're making a lot of money, doesn't matter. You can still qualify for this program as long as you currently reside in one of these designated areas. So again, how do we differentiate ourselves from competition? We are working pretty much around the clock. So I have an 8-person team. One of us is always available for a consultation, to do a credit check, to do an application with you. So in our field, timing is everything, especially when we're in a seller's market like this. You have to be prepared and ready when you want to make an offer. Otherwise, the house is going to be gone like this. So if you're looking to make an offer, you want to put your ducks in a row. You want to make sure you understand exactly where you stand so that we can move as quickly as you allow us to. We take a team approach. So like I said, we have an 8-person team. We can do a pre-approval within 10 minutes. So what we do is we send you the link for the online application. You complete it. We call you within an hour or less of you completing that application. And within that small time frame, we can have you pre-approved and ready to purchase a home that day. Just to give you an idea of how quickly this can move. One of the things that we do that no, I don't want to say no other lender, but no other big banks can do, we do what's called fast track approvals. So let's say you're looking to purchase in the next couple months, but you're not sure exactly where. We can actually get you fully approved that you can make an offer to a seller with a commitment in hand, saying to the seller, I am already approved to buy your home. Now, how does that make it? How does that differentiate you? Because if someone else is making the same offer, or even if your offer is a little bit less, is a seller more likely to take your offer or an offer that just has a pre-approval with no commitment behind it? So we found that to be a very powerful tool to help winning deals in this very competitive market. What we also call the listing agent. So when you make an offer, we actually call the seller's agent and advocate for you and tell them how strong and how great of a buyer you are. And then we also put our money behind our mouth. When we do a fast track pre-approval, a fast track full approval, I actually put $10,000 guaranteed of my own money as an offer when you're making the offer on the house. That's something that is unmatched and is not available in this market by anyone other than my group of loan officers. And that is what the $10,000 guarantee looks like. So I know I covered a lot. It's a lot to digest. Obviously, I know questions would be coming, and I'm happy to answer anything for you.
Hi, can you hear me okay?
I can hear you, Jennifer. Hi.
Hi, thank you so much for all of this information. This is really helpful.
I'm
I do have
glad.
a question. So I'm not a physician. I will be a psychologist.
Very cool.
Thank you. But so I do have a high total student debt amount with not as high of a salary as a physician will have. So when you're looking at the debt to income ratio, does that does the total student debt matter or is it more about the monthly payment?
It's a great question, and it's relevant to anyone that's going to listen to this call. It's all based on the monthly payment. So I have many different types of doctors and different types of professions that have a lot of student loan debt. But if they're on an income-based repayment program, let's say there's 300,000 in student loan debt, but the monthly payment showing on the credit report is only $123 a month. That's what we can use. If it's showing zero, that's a different story. So if it's showing deferred or zero, we do have to use a calculation of monthly payment that we have to count against you. So my advice is if you are doing a mortgage and you want to purchase a home, I don't want to say to start your repayment plan faster than you have to, but it might benefit you to start it at the lower monthly payment sooner than later so that we can help qualify you for a more expensive house. Because the calculation we use is typically a half or 1% of the total student loan debt, and that really does impact your debt to income ratio. So my advice is if you can do an income-based repayment plan and your estimated monthly payment is a lot lower than the numbers that I'm giving you, which it will be, that might be a good idea to utilize that as leverage. And again, Jennifer, we can discuss that when we do your personal consultation.
Thank you so much.
Oh, you're welcome.
This was amazing.
I'm so glad.
Wow, 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 wow. I do have one question.
Sure.
So I live in Fishtown area and I always see homes with displaying something about tax abatement. I think you alluded to it a little bit. Can you kind of explain what that is and what that means?
Absolutely. So a tax abatement means uh, it's a gift given by the city to encourage builders to build in certain areas. Okay. So when it says a tax abatement, that means that the taxes that you're going to be paying are based on the land only.
Mm,
Okay. So when you purchase land, the land taxes are a lot cheaper than when you actually have a home on that land. And the property taxes at that point are not just based on the land, they're based on the home that's on the land. So
Yeah.
when it says tax abatement, that means that you're only paying taxes on the land that's there. So
Hmm.
it's an incentive for people to purchase these homes because for a period of time, because there's not always 10 years left. There's sometimes only 3 or 5 or 7 years left. You're going to have a lower property taxes and a lower monthly payment on these types of houses, which is why the city does it to encourage people to move into these areas.
That
It's a
makes
great
sense.
question, Des. Does that answer your question?
Yeah, it does. That is
Great.
extremely helpful. Yeah. Okay. Do you have anything, like things that you should avoid or warning signs that this might be a bad investment? Like anything that people should look out for? Maybe
So
if they're buying in a different area, like because we have a Georgia campus and a South Georgia campus.
I would advise hooking up with a really good real estate professional. So the realtor is the profession that actually understands an area that you're looking to buy in. So I have a network of all top agents that I work with in a variety of different areas. So typically, I'll refer if a client comes to me directly, I'll refer them to an expert that is specializing in that area that you're looking to purchase in, and they can give you a great idea of what the pros and cons are and run you through things like the school district, the crime rate, the different things. Is the area gentrifying? Is it up and coming? Are there different? What's happening in this area? That's more because that's more geographically based. I can
Yeah,
only give my opinion based on my knowledge of certain areas. The real estate professional would be a better person to ask about that. But with regards to is now a good time to purchase a home? Any real estate investor will always tell you that the biggest regret they have was not doing it sooner.
right.
So
That's what it sounds like.
purchasing a home, like real estate, is the king. In the last 71 years, we've only had 7 down years, and you guys can imagine when those years were. For some of us that are a little bit older, some of us that are a little bit younger, during the recession in 2008, 9, and 10, and then during the banking crisis in the 1980s. So there were not many years that we've had down markets, and we've recovered pretty quickly. So real estate investing has always proven to be the king.
Very nice.
So that's since you're an example of wanting to purchase. Any other questions that you might have that will be relevant with relevancy to everyone else?
I have so many questions,
So
but I
many.
don't know. I honestly don't even really know where to start. It's so funny because last night I was like feeling really anxious about because our lease that we live in this house it ends in June, and I've
Hmm.
been so stressed about trying to like what our next step is going to be, and I really don't want to continue renting if we can avoid it. And everything that you provided about like the down payment and all of the programs and the resources was so extremely helpful because I know last year even I was trying to look up and see if there's any grants available or if there's any sort of like home buying assistance or anything like that. So that was extremely helpful. I'm like trying to take in all of the information.
Honestly, Des, everything starts with a conversation. There
Yeah,
is there is no reason, and there's no negative impact to coming to us and letting us do a consultation. We
yeah.
will show you exactly what you can afford, what numbers look like, answer any of your questions. Like most people don't even know if you purchase a house, let's say in March, your first payment is not due until May. You
Hmm.
skip the following month. So let's say someone is currently renting and their lease doesn't end
Oh,
for the month after, and they don't want to double pay, you don't have to. So
interesting.
there's a lot of nuance to purchasing a home and a lot of things that go into the mortgage process. Our
Yeah,
job is to create the best experience possible and inform and educate our clients to exactly what's going to benefit them right now and in the future. You don't have to want to buy or be able to buy right now to have a consultation with us. We want to
yeah.
put you in the best possible position so that home ownership becomes available to you whenever you want it to be.
Yeah, it always seems like such a like a big kid thing, It's like, oh, I'm a real adult now. I own a
Yeah.
home, I have property that I'm investing in. It always seems like something that is so far out of reach, but the way that you explained everything makes it seem much more attainable than I originally thought. So
That's
this was super
it's
helpful.
so attainable. Like I'm
Yeah.
telling you, I literally had a settlement last week where I had a buyer that got $1,800 back.
Wow. Yeah,
Back.
I've been seeing on Instagram that there's been a lot of crazy home sales happening like in the area that we live in. Like I saw someone purchase a home for like $15. I saw the $1,500. I saw zero down. They didn't have to pay anything. I'm like, what is in the water? How are these people doing these things? Do they have magic?
There
So
there
yeah,
are
you really
there
did dispel a lot of myths.
there are a lot of programs out there. It's very rare that you know can purchase a home for that little out of pocket, but there
Right,
are scenarios like that PHFA loan that I discussed at at a minimal with
right.
that 5% down payment assistance and with a seller that's willing to give a little bit of money to help cover closing costs. You can literally buy a house for 1,500 to 3,000 bucks. You can't even rent an
Crazy.
apartment
No,
right now, with first, last, and security for less than that. So
yeah,
I just encourage everyone to do a consultation because again, it's a soft credit check, and I'll literally be able to tell you, or any of my loan officers will be able to tell you what you can actually afford to purchase right now and what those numbers look like.
awesome. What do you say to people who are afraid that, it's technically cheaper to rent because you don't have to worry about the maintenance in a rental property? How do you answer that?
It's a great question. So you're literally paying to just live in a place. When you
Hmm.
purchase a home, you're purchasing an asset that historically appreciates at a level of 3 to 6% every single year. Not to mention, there are a lot of tax benefits to owning a home as well. There's something to be said about owning your own space and taking advantage of all the benefits that come with home ownership. So
Right,
we're a country that allows and promotes home ownership in a way that allows you to utilize very little money out of your pocket. So when you pay rent, you're literally paying off a landlord's mortgage when you could be paying off your own. Now,
right,
if you're in a situation where this is going to be temporary and you don't really know where you're going to be, that's another story. There are situations where renting is better for your situation than buying. But if you're going to be established in an area for 3 to 5 years at least, buying is always going to be a better opportunity for you because it's an investable asset that actually builds appreciation and value. So, and again, with other tax benefits and when you're purchasing in certain areas, there are a lot of incentives that allow you to purchase and make a really good home purchase. So buying, in my opinion, again, I'm biased because I believe in investing. I am a real
yeah,
estate investor myself. Buying real estate always wins.
sounds like it.
Well, let me say thank you very much first to everyone for the opportunity to chat with you all. And my contact information will be on this presentation. So feel free to reach out via text, via call, via email. We're always available for you and happy to answer any questions that any of you have.